Portfolio Builder members, today is September 5th. It's a Thursday. That means we're playing the bond market. And Uncle Sam paid us a very healthy paycheck today. We are firing on all cylinders. Predicted a huge move up in the SPY. Came faster than expected, but we were positioned perfectly. And because of the expected run-up in equities, we were predicting a down move in the TLT. And sure enough, that did happen this morning, and we came off with yet another profitable period on the bond portfolio. So if we take a look at the most recent trade alert, I'll show you exactly how we generated this income. Now, this is based on a rather large portfolio, so your results will be based on how many shares of the SPY and TLT you own. The more shares you own, the more income you can generate. A lot of our members like to start off with just 100 or 200 of each, get to try out the trades, and then once they're confident, start scaling up. So let's take a look at how this trade delivered profits even though the TLT traveled lower, and then we'll take a little bit of a glimpse at what today's new trade alert has. Now, just remember, if you are on an expired free trial, you're not going to see the exact trade alert in this video. You'd have to upgrade and get it inside of your email. Now, if you are on an active trial, you'll see the exact trade alert we're recommending today that will cover for the next week to generate income from the TLT. So let's just take a look at what happened. Now, as of recording this video, the TLT has actually dropped even further, which means your potential profits are greater than what I'm recording right here. I'll just throw up a quick chart of the TLT. Quite remarkable that we were able to call this top last Thursday. In fact, it did spike up. Was a little bit nervous because equities were going in the direction I picked, but the TLT was having a hard time selling off. Now it's selling off rapidly. So if you were following our trade alert, we had flipped our caller options upside down to profit from a down move. So perfect timing, and we'll look at the big macro view in a little bit. Let's just look at how the trade alert works. So last Thursday, let's just take a look at what your work was to generate this income. So if you're new to the program, you're going to always skip step one. Step one is just teaching you how to get out of the last week's trade. And last week, we actually made more money than we did on today's trade. We actually had a $1.94 profit per share of TLT last week. This week was a little less, $1.27. I'll show you the math. I just want to show you how easy this is so you can feel confident that you can do these trades. My dad likes to say it takes him more time to take out the trash than it does to put on these trades. And that's actually our goal. Why does investing need to be super difficult and complex? We can teach you how to simplify your life and only have to worry about 3 ETFs for the rest of your life. That's the SPY, the TLT, and GDX. We'll get into that in a minute. Let's just look at how easy this was to generate a profit week over week. Okay, so step one is you have to own 100 shares of the TLT. Option contracts are based on multiples of 100 shares of the TLT. And in fact, we're taking advantage of people who are too cheap to go buy their own 100 shares of the TLT. How funny is that? So step one is you have to purchase 100 shares of TLT. Now, don't do that without our options trades. We're not trying to get lucky on the SPY ETF or the TLT. In fact, we're trying to tame it down and make it something manageable for generating consistent, safe retirement income. So let's look at how we did that with this trade. So first is to sell to open the September 16th 145.50 call option. Now, if we sell an option contract, we actually get a credit to our account immediately. And in this case, we were getting a big credit of $1.70 per share. Now, on the other part of the trade, we bought to open the 149.50 put. That cost us a considerable amount of money. That was $3.70 a share to buy that put option. And if we look up in the top corner of the trade alert right here where it says last price, I'll try to zoom in for you guys. you can see when I entered this trade, the TLT was valued at 146.36. So let's take a look at what exactly we did and how this generated a profit. So we sold to open the 145.50 call. Now that's kind of funny because that means we're willing to sell our 100 shares of the TLT to the option contract buyer. We're the seller or the underwriter. The other person is the buyer, and he's getting the right to buy our shares for $145.50. Now if you do the math, that is about 86 cents less than they're worth going into the trade. So why on earth would we agree to do that? Well, it's because he's willing to pay a huge premium for that opportunity. So he paid us $1.70 per share for the right to buy that call option. So that means he needs the underlying asset to go up about 90 cents before he'll hit a payday and be able to cash out his option contract for a profit. Now, unfortunately for that poor sap, that did not happen. Today, the SPY is traded lower, significantly lower, and so his call option lost almost all of its value. Now, on the other part of the trade, we took that $1.70 and we invested it into an in-the-money put option, a very expensive put option. And you can see this gives me the right to sell my shares of the TLT for a price tag of $149.50. Now this is to some huge Wall Street bank who doesn't mind buying my shares of TLT at almost any price. He's in the business of selling put options consistently to generate huge sums of profits. So these big banks do this all the time, and typically you're going to find on the call option side, you're able to sell your call option to a relatively foolish speculator who's trying to get rich overnight. And so I kind of relate that to taking candy from a baby. Not very often will they win on that bet, but just to look at the TLT, you can say that these guys have done very well gambling on the TLT all year long. Now we never lose if we get assigned on that part of the trade because it's designed to have a profit no matter what for the option seller. The bigger fear is if the TLT drops in value, what happens then? Well, in this trade alert, we owned a very valuable put option that essentially allowed us to sell our shares for $149.50, but we did have to pay a premium of $3.70. So at the end of the day, this graphic right here shows you what had to happen to generate the profits. We needed the TLT to travel lower. Otherwise, we were going to lose money week over week. And in this specific trade, the most we could lose was $2.87, and the maximum profit was supposedly $1.13. But the catch is the TLT has dropped so rapidly today, it's increased the volatility of our put option, and we actually squeaked out an extra 14 cents. So let's take a look at exactly what we did to get in and out of this trade, how the profits stacked up, and we'll talk about what our outlook is for the rest of the week and the rest of our portfolio. Because remember, this is just the bond portion of our portfolio. Now, I do want to note we have a live chat box. I would love to hear from everybody listening. If you have any questions or comments, please leave a question in the comment box as I'm watching for any comments coming through or questions. So again, we sold to open the September 6, 145.50 call option, and we bought to open the 149.50 put. So I call this a upside down caller. This means we sold an in-the-money call and we bought an in-the-money put. We generate a profit with this setup if the TLT travels lower, but if the TLT were to continue flying higher, we wouldn't lose very much. So in every given trade setup, we have a maximum loss and a maximum profit, and that's that. So let's just see what happened. So what we got to pay attention to are really just two things. Number one, what was the price of the TLT when we entered the trade? What was the price of the TLT when we exited the trade? And then what happened with the option contracts? So we can look at the net debit down below of $2. That's what it cost us to enter the options. And then we'll see what it cost to get out. So I'm going to go to today's trade alert. And you can see the summary right here, but let's just look at the real screenshot so you can see this is the real deal. So I scroll down below. Here's your first step to get out of the trade. And so we nailed it. The TLT traveled lower to 144.74 when I took this screenshot. And in fact, the lower it went, the more profit we squeaked out this week on the current trade. And so you can see we actually get a credit to exit the option of 439. And we do have a question. Do you have to use the multi-leg button when making a call? No, you can do it one at a time, or you can do the order in one swoop. It's up to you. People in Robinhood typically will do it one trade at a time, and people in any other platform will typically do it in one order. And so that's totally up to you. It does not matter. All right, so let's look at the math. Here's where we entered the trade. TLT went from 146.36 and at exiting the trade 144.74. So we go up here where I've summarized this for you. And in fact, I even gave us a bigger loss than we really had. We actually made a little more than that, as you can see. But all in all, the TLT traveled lower. We lost around $1.22. Then we come look at the debit. We paid $2 to get in, and we got $4.39 to get out. $2 to get in, $4.39 to get out, $2.39 profit. Subtract the two, you get $1.27 profit per TLT share. Now in our portfolio, that's 3,700 shares of the TLT. That's a $4,700 profit in a single week. Now last week we were bullish on the TLT and had an even better payout, but these are not the average returns. These are just possible when the TLT is moving so quickly. And so here's our total portfolio strategy summarized and the return of the bond portfolio. So this has been a very smooth return. This is our best return to date in August, 3.6%. Now, if you do look at how I have the portfolio organized, you can see that I have about 40% of my capital trading the SPY, Monday, Wednesday, Friday. Same trade, same setup. Tuesday is an optional portfolio. It aims for a higher return with more risk. Currently, it's trading Facebook. We're set up to profit from a big move to the upside in the SPY and in Facebook. And of course, that happened today. We have huge gains sitting in our SPY program and in our Facebook program, which we'll cover in tomorrow's live stream. Meanwhile, our precious metals, they went down a tiny bit. GDX is our main position in the buy and hold portfolio for precious metals. It lost about 4% today, but you can see the total return is still up 53.2%, very close to what it was at yesterday. So not worried at all about that. We'll talk the big picture stuff in a moment. But again, this is the summary. Now, I do want to note that if you are on a free trial that has expired, you're not going to see today's trade alerts. You don't know what exactly we put into our options today to benefit from generating income from the TLT for the next week. And so if you do upgrade today, we can rush you out a copy of today's trade alert so you don't miss out. So call Dean 505-322-7515 to activate your account. We'll rush you out a copy of today's trade alert and make sure you get tomorrow's trade alert as well. And again, if you're just getting started, you might try 100 shares of the SPY and 100 shares of the TLT to get going. And we have a few different allocation options that we can provide you to make your life a little easier. So let me just review what those are right now. If you have $100,000 of capital and you want to take advantage of all trade alerts Monday through Friday, it's a 2-minute trade delivered right at noon Eastern, It does not take much time. There's absolutely no touching these trades outside of the set dates. So the SPY, will only be traded noon Eastern, Monday, Wednesday, Friday. The Tuesday trade will only be touched on Tuesday at noon Eastern. Currently, that is Facebook. But I told you guys, soon as the SPY pops above 300, we'll be rotating out of Facebook into a safer security, Microsoft. Once we get the SPY up towards 315, 330, which I believe will happen by early October, we're going to rotate that into the silver ETF, which has been the set of combo trades that's generated a huge return on our Tuesday play. Now, I would love to get into Apple on our Tuesday play, but not until we see what happens in October with the trade war. I think it's going to escalate, and I think we have a whole new heap of volatility coming our way. Everything's happening faster than I expected, which is okay because we were set up to benefit from exactly what happened in the last 48 hours. Now, Thursday we play the bond market with the TLT, and usually I'll set them up so if the SPY takes a hit, the TLT pays off, and if the TLT pays off, then the SPY may take a hit. The current setup was designed to predict a big move up in the SPY and a down move in the TLT. So if I was wrong, we could have had a loss on both portfolios, a limited loss, but what we predicted did pan out, so both portfolios are enjoying a nice run up today. Now, we're still recommending a 10% total allocation to buying and holding gold. Now, not GLD, the spot price of gold. That can be somewhat manipulated by the central banks as they decide to start to load in gold or dump gold. They can significantly manipulate the price. My expectation is that they won't dump, but rather they will just start to hoard it and control the price. So if they start to limit the price of gold at this $1,500 level, investors are now going to start thinking about who can produce new gold. That's the Gold Miners GDX. Is a beautiful ETF. Has something like 25 plus top gold mining operations, and it's automatically calibrated for you, just like the SPY ETF. So this allocation right here is beautiful. It is very hard to lose money. It's an all-weather portfolio that you can use to generate retirement income in all market scenarios. Now, for those of you who want a little less work, you might consider dropping the Tuesday trade and just trade the SPY Monday, Wednesday, Friday with 100 shares, 200 shares of the TLT on Thursday, and then still buy and hold 200 shares of GDX. So this is how I would allocate a $66,000 portfolio. Now, of course, you can multiply this. You just want to keep the ratios exactly the same to have a well-balanced, all-weather portfolio. Now, for those of you who really want to spice up the returns and work the least, this setup has the highest return by far because our Tuesday trade has almost outperformed the SPY 2-to-1. Now, sure, it takes a lot more risk. We're hand-picking the exact security to trade on Tuesday, so we're having a lot of business risk in a specific stock. Now, the SPY has 504 companies in that electronic traded fund, which makes it very hard to have a big loss. With our strategy, we always have the put and we always have the call. So I'm okay singling out the best security for that week to put our money behind. This trade alert setup would only trade Tuesday and Thursday and cost around $38,000 to build. You would have 100 shares of the Tuesday pick. Currently Facebook, but pretty soon we're going to need to rotate into Microsoft, less volatile stock. When the next trade war escalation does happen, I want to own the least volatile stock possible if I'm not expecting it. And if I am expecting it, we'll be holding the SLV silver ETF. So expect us to rotate into Microsoft in the next week or two. And then after we've rode that towards October, at some point in October, I'm expecting to switch to the silver ETF, as I don't think any trade war progress will occur. Now, again, we still want to buy and hold GDX, the mining ETF. This will likely be a great buying month for gold, as there's quite likely going to be either a small pullback or a flatlining in gold prices as we wait and see what happens with the October trade war talks. So again, if you don't want to miss out on these trades, call Dean 505-322-7515. Let's activate your account. And also, I want to remind everyone, we have a live webinar every Thursday at 1 p.m. Eastern for people who are interested in joining our program. Now, yesterday was for our paid folks. So if you're on a free trial or an expired trial, you'll get the Thursday webinar invite. But if you actually upgrade, you'll get to join our paid members webinar every Wednesday. Okay, so let's jump into some of the content for today. And real quickly, I'll just review our trade returns. The SPY program is currently up 11.5%. The Tuesday trade is on fire. It's up 21% this year. And I want to really point out, this is not just some sort of buy and hold strategy where we're getting lucky and taking on lots of risk. Not at all. We are actually limiting the returns by selling call options, which has dramatically reduced the profits of our portfolio. And then to further reduce our profits, we're buying put options at all times underneath our assets. So we've generated extremely high returns this year with extreme amounts of protection to the downside risk. If I had removed all the downside risk and not sold the call options, we would potentially have much greater returns than we're advertising here. But that's because this program is designed for safe, consistent retirement income. And our goal is to achieve around a 1 to 2% return per month with very, very little risk. And so far to date, we've done just that. Only one losing month, July, we lost 1%. I'll tell you why. I thought in June, Trump would raise the tariffs, escalate the trade war. And we're flying out to Hawaii for a vacation, actually for Dean's wedding. So I wanted to play it really safe. And we had all the protection you can imagine going into July. And guess what? They went to Japan and said they're going to work on the trade war in a positive manner. The markets flew up. We lost 1% by being completely wrong in terms of timing. But then guess what happened? In August, the trade war escalations came. We nailed it, and we have actually our best returning month of the year just last month, 3.2%. So for every $100,000 you have to invest, you can essentially assume our goal will be to generate your portfolio around $1,000 to $3,000 of safe profits. Now that doesn't mean we'll always be able to pull that off. You can see we have had some slower months, but in general, we've done a very good job at delivering the target profit of between 1 to 3% total return month over month. All right, so that's a look at all the strategies combined. If I scroll down, you can see the returns of each system broken down separately. So the SPY program had a nice month, 2.2% in August. July, it had a negative 1.1% return. May, negative 1.2%. Outside of that, we had a flat month in April and generated nice profits in June of 3.4, March 1.5, February 2.6, January 3. The equities portfolio number 2 has been pretty insane. It does take more risk, guys. When we get the market direction right, we're going to see much bigger profits in this portfolio. But when the market changes directions and we have not anticipated it, that's when we can take bigger losses. Keep in mind, I always have a put option below the security, and I'm always selling a call option above. So this does limit our upside potential, and it helps finance the insurance plans in case something goes wrong. We don't take a big hit. So you can see we lost a little bit more in May and July, negative 1.3 in both of these months. And in December, we had our biggest loss, negative 4.3. Other than that, it's been some pretty big gains. 4.8 in August, 6 in June, 1.5 in April, 3.9, 3.6, 7.7 to start out the year, and coming off pretty hot in August with 4.8. Year to date, if you exclude the losses in December, that's a 27% return. All right, let's look at the next portfolio's returns. This is our buy and hold precious metals portfolio, where we're essentially trying to predict what the big moves of the central banks will be and how that's going to affect the precious metals and cryptocurrencies. So go back to December, we had a 2.5% total allocation in this portfolio, and we went long a couple cryptocurrencies. At that point, the stock market was crashing, and the Fed was sitting there saying they're going to keep raising interest rates and continue reducing its balance sheets. Stock market hated that. And so many were starting to speculate that the central bank would have to start lowering rates and eventually start up QE. That's what's extremely bullish for gold and why we are still recommending a 10% allocation to date. We've been slowly increasing that allocation size as the Fed has completely capitulated. And if you go back to February, that's when they said the rate hikes and QT were going to end sooner. In fact, in February, they stopped the rate hikes and said QT would end sooner. July, we actually saw them drop the rates, 25 basis points. In August, we saw them pick up some $15 billion of treasuries at the 10-year mark. Nobody even knows why yet, but it happened. Now we're wondering what kind of rate cut we'll get in September and if they're going to continue to pick up bonds. So a lot of exciting news coming. My expectation is a 25 to 50 basis point cut this month that should send stocks flying, probably just keep the bond market content for now, and set up the path for gold to really break into new highs. Now, maybe spot price gold gets somewhat suppressed by central banks, but the mining companies, you're actually investing in shares of their company for future gold they will mine for years to come. So that's why I like GDX, and I think this is going to be a great month to really make sure you have your gold position. Will we probably see some drawdown as equities fly higher? Sure. But come October, when the trade war fails to make any progress, and we also have at the same time central banks lowering rates, starting to buy up government debt, I think we have a huge move ahead for this portfolio. So it says a 50% return, but that's because I continue to dilute the portfolio by adding capital to it as this story unfolds. And it becomes more clear that China does not want to make a trade deal. So the returns have been insane. In May alone, we had a 60% gain in this portfolio. August has been slow, only 3.9. July, we had a loss of 11%. January, a loss of 12%. But outside of that, we've had huge gains in the double digits. Now, I'm not recommending you go put your entire life savings into gold because it could be as simple as China saying, all right, we'll buy some farming goods. We have insane runaway inflation in food. Our pork supply is poisoned. They're really struggling to deal with pollution in China, and you're seeing it in their agricultural system is just having tons of unedible food, which is causing prices to skyrocket. Couple that with them stopping their purchases from America and trying to get it from other locations that are just not well oiled to deliver the amount of food they need. So that's the big thing that's sitting in front of the precious metals market that could cause it to absolutely tank. That or central banks just trying to manipulate down the price of gold. So currently I like the 10% total allocation in GDX to keep your life simple for this part of your portfolio. And the bond portfolio has been really, really strong. Surprisingly, the only loss we had is when the Fed actually pivoted. And perhaps they didn't pivot enough to make the bond market happy. Clearly not. We saw them push prices extremely high in terms of low yields. And so our only losing month in the Thursday play was February, negative 0.8. Outside of that, we've delivered returns as little as 0.5% in April, our best return in August, and it's been one crazy ride on the TLT. Now again, This portfolio would be up much more if we were not busy selling call options above and buying put options below. But that's okay. We want to avoid huge losses to our account, and we can dramatically control how much risk we have in any given trading period by simply owning a put option below the underlying asset. So the bond portfolio, we use puts. The gold portfolio, we do not. So this is a smaller portfolio that I'm willing to allow to swing to the upside and downside to hit these huge gains. And quite likely, come October, I may have some interesting surprises for what we're going to do to optimize this buy and hold portfolio and potentially pick up some huge gains in October. So the timeline for what I was expecting is actually happening faster, but it's happening exactly how I thought it would, which is creating faster profits than normal for our portfolio. Tuesday, we do have the put. Again, it's designed to generate income, not to generate growth. And the Monday, Wednesday, Friday, always we have a put below to protect our capital. Okay, so that's a summary of our trades. And again, if you do want to upgrade and not miss out, call Dean 505-322-7515. If you're just sitting long a bunch of equities, you're probably feeling pretty good right now. But here's what's going to happen. U.S.-China trade war is going to most likely make no progress in October, and we're going to see the next round of escalation sometime in October, maybe November. I thought this would be pushed into December or January, but we can see clearly everything is happening very, very fast. All right, let's take a look at the big news, and we'll let you guys go. And if you want, please try to make it to our webinar. That's coming up in about an hour and 15 minutes. You'll have an email in your inbox to access that webinar. Okay, so the big news over the last 24 hours was two things. Number one, well, really three big events. Number one, the extradition bill in Hong Kong was reportedly going to be removed next month when they reconvene. So it hasn't actually been removed, but they said they will. So that shows a huge de-escalation in that part of Asia. Number two, we now have confirmation that the U.S. and Chinese are discussing a continuation of the trade war talks. I think the best outcome possible in October would be the Chinese decide to purchase agricultural products. If that happens, this would definitely allow the SPY to potentially go above where I think the danger zone is, which is in the 310 to 330 range. Now, if what I believe happens and they do not buy agricultural products, most likely U.S. is going to escalate by putting the sanctions on Huawei that are pending. This can completely cripple their big phone company that actually has more sales than Samsung or Apple. It's a mega company. And currently it's on life support as they wait to see what the U.S. is going to actually do. So beyond that, we are also wanting to see the Fed speakers come out and forward guide us as to what they will do in September. And so funny enough, they were not giving us hints that they would lower rates for the last several weeks. And this is despite every other central bank around the world, over 30, lowering their rates and starting up some form of quantitative easing. So yesterday, sure enough, they come out, they're throwing out 50 basis points. Another guy's saying 75 basis points. So the market loved to hear that. And now we get this big move up in the SPY. Okay, so let's take a look. We've got some news wires that they're going to be meeting in October. Apparently they have to have a small meeting in September to talk about what they'll talk about in October. Here's a Peter Schiff quote. Now, I do think he gets some of his clients from Russia and China. He's always on RT News. And he's always very supportive of the Chinese. And his sole goal in life is to sell you 5 to 10% position in gold. So that's fine. and I like to listen to his podcast with a grain of salt. Gold is trading lower on news that China and the U.S. will resume trade talks in October. Though an actual truce is unlikely, gold's rise is not related to the trade war, but the currency war, which will continue to wage. In a currency war, the only winners are gold and silver. And the dollar. So I think he is right in general on the call on gold right now. But I also think that this will push our bond portfolio higher come October and give us the next big sell-off in equities, which we will be prepared to take advantage of with our buy and hold portfolio. There's a handful of ETFs. There's 3 that I really, really like to load up on come October. Okay, so next, China and the U.S. announced new round of trade talks and will work to make substantial progress. Personally, I think the U.S. worn out by the trade war. What a joke. May no longer hope for crushing China's will. There's more possibility of breakthrough between the two sides. Breaking: China's Vice Premier Liu He and U.S. Trade Representative Robert Lighthizer and Treasury Secretary had phone talks. Okay, same memo. Here's the negative yielding debt bonds around the developed world. Last place for positive yield on a bond is the U.S., which continues to support our thesis that as long as we just kind of rumble the emerging markets, China, just shake them up a little bit, it's causing them to kind of sink down lower, washing out all their bad investments, causing a huge capital outflow into U.S. products from the dollar, the U.S. stock market, and the U.S. bond market. Now, if we don't shake them too hard, this trend can make the bubble just really expedite in our favor in terms of being long U.S. equities, long bonds, and long gold. But if we shake the Chinese too much to the point that they implode and strike back, that's where I could see U.S. equities finally taking a huge hit. And then, of course, we want to be long our bond and gold portfolio. Apple to sell $7 billion in bonds so that it can buy back $7 billion in stock. There's actually these top companies with the best credit ratings are now out there selling negative yielding bonds into foreign markets, mainly in Europe. So this is just getting completely loony. Until we break the cycle where these corporations can borrow money for next to free and then recycle that money into buying back their own stocks, it's going to be very hard to put much of a dent on the U.S. stock market. President Trump asked if he's concerned about the Chinese trying to hurt the U.S. economy by selling U.S. debt. It says, first, the bonds have to come due, and if they didn't want to renew or re-up, as they say on Wall Street, that would be fine with us. There's plenty of demand. And that's true. There's very little option out there for generating yield with the current setup. So I do believe this is true. Also, it's very fascinating. The Chinese have been buying forward swaps on the dollar, and it's not quite clear how much, but they've been trying to short the dollar with this forward swap derivative. Essentially, they buy a contract that allows them to exchange their currency for the dollar at a future date, and they would generate a profit if the dollar were to lose value. Unfortunately for the Chinese, that has not been the case. Even with Ray Dalio and Jeffrey Gundlach harping up the weakness of the dollar, the exact opposite has happened. And as we imply these tariffs and the Chinese devalue their currency, I do believe that is the single biggest trade of the year, is watching the yuan continue to devalue as their economy is under tremendous pressure. They have leveraged their line of credit to the point that they cannot borrow much more money, and they're starting to lose relationships with important banks like HSBC. We'll look at their chart in a minute. They are not Chinese companies. They are CCP or state-owned and should not be allowed to raise capital here. Okay, so again, we cannot audit Chinese companies. They say it's a state secret and illegal to look at the internal financials of their companies, which are listed on the New York Stock Exchange. So you can thank all these U.S. bankers for flowing all our capital into a country that's now competing to take over the leading role in the world. So that's why I do like the Yang ETF. It's a 3 times bear ETF that shorts FXI, which is the large cap ETF that has several $billions in it. There's probably hundreds of billions of dollars that have been funneled over to China from all these index products that the big banks have been putting together over the last decade. And so that could be something that is dramatically controlled by the U.S. government. And I think that might be one heck of a play for us is the Yang ETF. That's one of the positions I want to put on in October after we see the trade talks start to break down. And I think this will be after we've seen a huge rally in emerging market stocks and U.S. stocks going from now until October. All right, let's take a look at some more data here. Okay, so here's some tweets about the Fed officials. We got Microsoft meeting with Facebook at their headquarters related to the 2020 election. So that is also something very interesting that I'm paying close attention to. Who's going to be the runner-up for the Democrats? Is going to be Biden? Is it going to be Yang, Kamala Harris? We're going to have a surprise of Michelle Obama coming out, maybe Hillary Clinton, who knows? But something I do follow. I'll give my predictions as we get closer and closer. Fed saying, hey, it's time to lower rates with Kashkari. ECB Lagarde recommends highly accommodative policy. She's one of the most dovish central bankers of all times. And they've been joking about a bazooka of stimulus coming to the Eurozone with the ECB. We'll see. Bullard says they should drop by 50 basis points. And then they're saying, do we hear a 75 from Kashkari? Going once, joking as if it were an auction. I don't know. 50 might be a little heavy. I'm kind of thinking it's going to be 25. It puts the U.S. in a very strong position to have such a strong dollar. Maybe not for our exports, but in terms of keeping control over the markets and making the capital flow to the U.S., by having these higher interest rates, it's proven to be very, very profitable for the U.S. this year. And I think it will continue to be so. So we'll see, do they really drop by 50 or are they only going to get 25? And I think the odds right now are leaning towards a 25 basis point cut. Here's a look at the top stocks I track daily. Our Facebook play, killing it. From Tuesday, FXI is the large cap Chinese ETF. We had been buying put options on that, but that's a little harder to manage because of the option premium evaporating over time and people trying to figure out how to follow it. So rather than recommend put options on FXI, I'll simply be telling you when to buy a position in the Yang ETF, which accomplishes the same thing and is easier to manage and maintain. Now, I think we're way too early to do that. Look for the alert in some point in October to purchase some Yang shares. Now, if they come out and say they're going to buy farming goods, all bets are off. Look out below on gold and bonds, and go long equities will be our recommendation. But I don't think that's most likely to happen. GDX is our favorite ETF to get a great exposure to gold mining companies. This single ETF has some 30 plus top gold mining operations that are weighted based on their market cap. Very easy way to have great exposure to that sector with very little work. It's down 5%, no big deal. This is a total position of 10%, and I think that this will be a great buying opportunity if you're low on that position in this month. Now it may stall out a little more this month, but the next time we get a trade war escalation, it could jump. And if the Fed is a little bit more dovish than people expect in terms of talking about QE or lowering the interest rate a little faster, or even if the central banks around the world are being a little extra dovish, there's plenty of support to pick up gold as long as this trade war is going to continue lingering on, which I'm quite confident it will. We have HYG, high yield corporate bond ETF. That is perhaps a better leading indicator for a crash in credit. LQD is the one that really needs to fail before the U.S. equities market will stop having this feature where corporations buy for cheap or borrow money for cheap and then turn around and buy back their own stock. So LQD and HYG are the corporate related credit markets. If those start to tank, I would be concerned about the health of the U.S. stock market because those are the main buyers of the U.S. equities. All right, here's a look at the TLT, the play of today. Having a little bit of a sell-off today, you can see, which we predicted last week, generated a nice profit. And we may have to continue this trend for another week or two. I'll be a little skeptical to be bearish the TLT ahead of the Fed meeting coming up in September 18th. So maybe 1 or 2 more weeks where we bet flat or down on the TLT and then expect to reverse the option caller to benefit from a rally in the TLT. SPY, I think, is going to go up above 300 into what I call the danger zone, which is in the 310 to 330 range. So I think we'll hit those targets by some point in October if the Fed is at least cutting rates by 25 basis points. I think that's about all it would need to get there. And then look out below, as I do believe trade talks will fail in October. Here's that LQD. As long as this is in a healthy bullish pattern, we have a lot of support for stocks. GDX, again, little sell-off today, not worried about it. You can look at how far up this ran from the 2008 crash as they started printing money for a good several years, and that pushed GDX shares all the way up to 66. I think it could go much higher this time. The amount of debt we're trying to service by printing money has more than doubled. So the next scare and round of stimulus to try to stop a recession could be absolutely out of this world in terms of trillions of dollars printed. HSBC has broken off its deal with China to support its currency. Not a lot of facts we can get on that, but we did see a huge sell-off and a lot of rumors, some big heads, including the CEO getting cut, even though they had pretty strong quarters. So this is a huge bank in Europe that we track as perhaps a canary in the coal mine for a warning that there's trouble ahead. So it is rallying, a lot of buying going on here, so that gives us confidence going into this month. Same thing with Deutsche Bank, the German bank. Here's the yuan against the dollar. When it's going back down, that shows tensions are easing. When it's going up, tensions are certainly rising. And I believe this will continue to devalue. Here's the big picture. The problems China is having are much more dramatic than they did in 2015 and 2016. And they solved their issues in 2015 and 2016, where they're having a massive slowdown in growth by starting up a huge round of stimulus, which was primarily infrastructure build-out of housing and this Belt and Road Initiative. So they're sitting at some crazy 300% debt to GDP. They've flooded their economy with tons of currency, but they have capital controls that makes it illegal for the money to escape. So as these rich Chinese do everything they can to sneak out of China in terms of getting out of the currency, we're seeing them slowly but surely lose control of their conversion rate and seeing things like gold, Bitcoin, and the dollar rally. So I do believe this trend will continue. The euro most likely will continue to drop against the dollar as they roll out their bazooka of stimulus. So again, it all supports this thesis where if the rest of the world is lowering rates, printing money, there's more money out there, that makes the relative value of all U.S. products go up in dollar terms. So it's going to make the dollar continue to rise, going to make the U.S. bond market continue to be strong, and the U.S. equities be the best bet for return, as long as the trade war is just how it is. No massive escalations between the U.S. and China. The German 10-year bond is the best leading indicator for trying to predict treasury moves. And you can see the big picture is Germany is in trouble. Their yield's negative. People are paying money to borrow, to lend money to Germans. And the only reason they would do that is because they know the central bank will eventually have to step in and buy up all these bonds to protect their bond market and cash out all these speculators. Here's that uptick in the German bond, which is just sure enough also happening in the US 30-year, which is what our TLT plays on, and how we generated such a nice profit. So a little bit of sell-off in Ethereum. Bitcoin's remaining strong at 10K. Now this is your rebel without a cause currency, black market currency. There's plenty of room for this. If you look at the grand scheme of things, there's some 260 trillion in government debt out there. That's like the total money supply. The main way credit is created is through government debt, and then it flows into the economy, and these balance sheets just grow year after year after year through this main mechanism. As the money supply increases, we're seeing the value of everything go up in dollar terms. And so that's why we're seeing Bitcoin go from a third of a penny up to 10,000 since the '08 crash. Some 3 million% return. So it will slow down, but its market cap is only $200 billion and Ethereum's is only $20 billion. So these can easily be manipulated in either direction, but right now the force is pushing money into these assets because all the emerging market currencies are crashing and the people who hold those currencies are losing value and purchasing power. So they're looking to get rid of their currencies and pick up the dollar, gold, and even some of these rebel without a cause currencies, Bitcoin and Ethereum. All right, that is a wrap for today's presentation. If you want to follow our trades, call Dean 505-322-7515. We've got a live webinar in 1 hour. Check your email for the link, and we'll see you then.